Okay, recording this video. It's actually Sunday night, 20th of November 2011. Hope you had a good weekend. And I want to respond to a couple of emails I got over the last couple of days to do with systemic risk. Systemic risk being the question, is my money safe? And this is something that's actually been on my mind for the last couple of weeks. And these two questions are to do with the Euro and MF Global. So I've got a couple of thoughts, as usual, never short of thoughts. Let me kind of respond to each of these questions. The first one's from Sam. I think Sam's in Ottawa, but he's got a question here. My question is about the Euro and capital. With today's crisis and problems in Europe, would you keep your capital in the Euro currency, knowing the economy problems in Europe? Keeps on going on, blah blah blah. Do have most of my capital in euros, and I'm scared of the situation in Europe, and if the euro's gone to parity with the dollar and the other markets. Best regards, Sam. Let's talk about the euro. I'm actually sitting here in Europe, in southwest France, in Biarritz. Had a great time here, but I've got to tell you, if you're in North America right now or Australia, I mean, the situation in Europe is not good. Sunday night here, we've just had news that the incumbent government in Spain has been rolled. We've got a new government in Spain, and the Europeans have a hell of a problem in a euro currency. Everybody knows kind of the issues, whether the ECB can act as lender of last resort and so on, and what they're going to do in terms of supporting the bond markets and driving down interest rates. Because if interest rates kind of keep on going up, we've got a systemic crisis here that'll roll from government bond defaults to a collapse of the banking system, therefore a collapse in asset prices, and also the collapse of the pension system. So this is like a domino effect that'll happen extremely quickly once one or two of those things starts to move. Now, I looked back at my kind of videos. 9th of June was when I started to get pretty bullish on the US dollar and bearish in kind of risk currencies, and that trade's taken a long time to kind of play out, and I moved my currency, my trading currency, into US dollars kind of way too early and missed a nice little pop in the Aussie dollar. But let me just revisit some of those charts and tell you what they're saying about kind of the euro situation. The first one is commitment of traders numbers, and I don't actually show these commitment of traders charts very frequently, just because on a week-to-week kind of basis I don't find the commitment of traders information all that helpful these days. Months ago, years ago, I spent a lot of time kind of updating all the commitment of traders information, but that's kind of the story. I don't find it as useful, but in terms of a longer term picture, it is pretty helpful. So what I've just brought up here is a monthly chart of the dollar index. So this is going back to 95 through to 2011. You can see here we've got what the dollar index has done. This is leading into the 2000s, 2001. We had all the money kind of moving into the tech boom in the US, and the dollar index was extremely strong. And then since then, with the Fed printing of money, we've actually had kind of a decline, pretty steep decline, from 130 down to 75 or so, 74 on dollar index in the last 10 years. Beneath this is commitment of traders, the professionals numbers flipped upside down, and the reason I flip it, because I find the most useful indicator is to look at divergence patterns between what's going on in the commitment of traders, the professional numbers, versus the price index here. And you can see kind of coming into these highs, we had all these kind of cluster of divergence signals with the commitment of traders numbers before we kind of fell off a cliff here. Now, the thing with all kind of divergence type indicators, you never know which one is going to be the final pop. You can see kind of the pattern kind of building up until the energy gets released, and then we get this kind of decline. But you never know when it's actually going to happen, whether it's going to be this divergence signal or the next one that's kind of going to be the final one. But it just shows tension in the market that eventually kind of gets released. Now on the downside, so we've had this kind of huge fall off in the US dollar over the last 10 years. You can see we've got a similar pattern kind of building up here at the bottoms. So we've got all these divergence patterns kind of setting up around this fairly tight band now. In terms of the blow-off activity in dollar index kept on moving up, but over the last 2 or 3 years, dollar index at these lows has been pretty confined up in this kind of 74 to 80 type band here, and we've just had these couple of divergence patterns kind of start to play off in the last couple of months. And then you can see the other pattern that we can see these kind of gradually flipping over of the index here, the commitment of traders index kind of going over as we kind of go over the cliff here, and we start to get all these kind of downward spikes. Well, we're starting to see these upward spikes in dollar index kind of starting here. So that's one of the reasons why I started to get pretty bullish on the dollar index kind of back in June, and just been waiting for this to kind of play out. In terms of the weekly chart, you can see exactly the same thing, a little bit more detail. So coming into these lows, all these bullish divergence patterns kind of come in. You can see it quite clearly on this chart, how this kind of negative readings over here in this kind of flipped commitment of traders numbers here have gone from quite extreme to these really shallow readings lately over the last 6 months or so, and now quite bullish readings. We're starting to move to the upside, and I believe break into an uptrend. Similar pattern you can see in an inverse in the euro. So the largest constituent, I think, is about 30-40% of the dollar index is the euro currency itself, and you can see exactly the kind of the flip in the euro. So monthly chart again, commitment of traders numbers kind of flipped upside down, kind of not sure why the bullish divergence pattern didn't kind of signal here on the price bars, probably just a setting in terms of the indicator, but then you can see the bearish divergence patterns kind of setting up at the highs here. And then the same type of patterns, previously we had quite high numbers in terms of these flipped commitment of traders numbers, and now the last time we kind of were up at these peaks at about $1.50 versus US dollar. These highs were pretty weak compared to what we've seen historically, and now the negative readings here are actually reaching quite extreme values. So we've had this kind of play out in terms of topping out activity, and then just going to the weekly chart here, same thing, run up in these divergence patterns, and here you go, you can see the divergence patterns happening in the commitment of traders numbers, how we run up to new highs, and the professionals are saying no, don't I don't believe this, and kind of we flip over and we go into this massive kind of decline. This is basically the collapse in the markets in 2008, where everybody rushed into safer assets, US dollar and US treasuries. So the bottoming patterns that we've had, a couple of them here on dollar index, have signaled nice little rallies, but then we've started to have these decline numbers here, and you can see these readings now in the commitment of traders being very kind of negative in terms of these flip numbers on the professionals. So that's at a big picture in terms of commitment of traders, something that I was kind of looking at over the last 6 months or so, and saying I'm seeing a pattern where we're bottoming here. And then if I just go to the dollar index charts themselves, just the simplified charts here, just showing, for example, monthly index. So 2001 peak in the dollar index, and we've kind of played down here into a pullback to end of trend sequence, and then a second cyclical turn after end of trend. And I talk about these second cyclical turns after end of trend, pretty significant potential areas where you might get a reversal of trend. And you can see the huge volume swings that we had over this kind of period where we had money kind of flowing in and out of the US dollar. And the last couple of times we've kind of had these huge kind of, this is where everybody was saying the dollar index is toast, and why would you buy it, and we had the debt crisis and all those kind of things going on. Well, the US federal debt crisis really kind of, for me, marked really the bottom in that dollar index right there, and we just couldn't get past that kind of 74 type level. So you can see with all this exhaustion selling down here, the price destruction in terms of the dollar index has been really muted. And of course, as usual, come the lows. Look at all these bullish, these blue professional bars kind of coming into these lows down here. If we go to a weekly chart, similar type pattern where we've had these kind of exhaustion selling signals down here. Now these haven't gone off as actually exhaustion selling signals just because this peak was so high and we needed something of a reading similar to that, but these extreme kind of selling signals that we've had down here, here and here have been of the same order of magnitude, at least, as that exhaustion buying signal there. And you can see the last one that we had here was almost like a flush signal. So we had like an exhaustion selling signal. The bullish divergence patterns kind of come in, and I talk about these. When these start to line up, we're always going to get a final kind of flushing out of the volume, and that's where it happened a couple of weeks ago. And from then the market's kind of rallied, and we've not put in this cyclical low on the weekly chart, and we're kind of heading back up to this cyclical resistance area where we might kind of poke through and go into an uptrend. And on the daily chart, we've started doing that already. We've had our exhaustion selling on this time frame. Blue professional down bar didn't get taken out at the lows, and we've started to rally, and you can see the energy has gone kind of positive here, and we're about to break in, I believe, into an uptrend here. So the euro chart's kind of very similar to this, just kind of the inverse of that. But for me, what it points to is the strength in the US dollar, and the strength in the US dollar, I think this time around, is being driven by basically risk-off type move, and people moving out of the euro. Now, Let's see a couple of recent news stories, and you might have seen these if you follow some of the blogs that I do. So this is taken from Business Insider, and this I think was today. This is the pigs versus German bank deposits. Now this is pigs without a double I, so this is without Italy. So this is Portugal, Ireland, Greece and Spain versus German bank deposits. And the pigs are shown in blue, and you can see over the last 2 years the deposits in their banks kind of maxed out and have been in decline. In Germany, we've had a stalling initially of their deposits in their banks, and then they've started to rise slowly. What I believe is happening in Europe at the moment is we have a stealth run on the banks. No one's talking about it, no one wants to talk about it, because if you start talking like that, there'll be a stampede and we'll get a run on the banks. And because we don't have a lender of last resort in the ECB willing to come in and stop a run on the banks, there's nothing like FDIC insurance here. Although after the global financial crisis, some of the governments kind of came in and said they would support the banks and to stop. For example, in the UK we had the run on Northern Rock, and so the government did step in there, nationalise the bank, and stop things like that. But if it's a lot of people in Europe, if they start kind of getting wind that their euros are not going to be safe in their banks, now where do they go? In Europe, where you go is Switzerland. And then this story popped up on Zero Hedge on Friday or Saturday, and this one's called "On Capital Flight and Forced Repatriation." And let me just point out this little section kind of halfway through from Brussels. So this is, quote, "The European Commission is helping Greece negotiate an agreement with Switzerland to repatriate as much as 81 billion believed to be hidden in Swiss bank accounts," a high-level European Union executive body official said November 17th. $81 billion in deposits from Greeks in Switzerland is a big deal. Greece is about 11 million people, so that works out at something like $7,000 or $8,000 per man, woman and child in Greece kind of moved their money into Switzerland. So this is a little bit of kind of rumor mongering, although Zero Hedge I have huge respect for. It's not the kind of thing that they do, but these kind of rumors are kind of going around, and these are the stats in terms of the bank deposits. So what do you do? My personal opinion is you stay away from the euro right now. Why would you take the risk? Now we can have a conversation on this. Emini-Watch is 4,000 subscribers and a couple of thousand visitors per day. It's a minnow in the whole kind of scheme of things. But if you couldn't read a story like this on the front of the Wall Street Journal or the FT, because they would be accused of destabilizing the euro and destabilizing the banking system. So you're never going to read about this. It's just going to one day happen, if it's going to happen. But why take the risk? I just don't see why you would do it. And for me and Mrs. Emini-Watch, we're trying to figure out, well, what's the best thing to do? How do we take advantage of this? How do we at least kind of protect ourselves from the downside? So we talk about kind of where's best to keep your money and so on. And we have zero in euros for that reason. That's question number one in terms of the euro, and I've been talking since the 9th of June about how I'm not a fan of the euro, and I think that there's going to be a run to the US dollar, and so in terms of my trading capital, I've moved that all a little bit too early, but I've moved that all into US dollars for the time being. Sam, I hope that kind of helps to answer that question. I think it is something you should be worried about, and I think a prudent person would take steps to mitigate a potential downside event. And isn't it extraordinary that 3 years after global financial crisis we're talking about this, because none of the problems have been solved. We've swept them all under the carpet. No one has gone to jail. The regulations have not been put back in place like Glass-Steagall to stop this. The leverage of the banks has not been reduced, and the debt has continued to grow and grow and grow. You'd had to be a bloody idiot not to kind of fix the problems that were staring at us in the face 3 or 4 years ago, and we have done none of that, so we're going to have vengeance visited on us, I'm afraid. Next question is to do with something that does make my blood absolutely boil. Now this is from Jason, I believe, in Colorado. Barry, wondering if you could make time for a comment about the MF Global situation in one of your next vids. I know not the focus of the website, but your experience and comment would be respected. Well, it's very nice of you to say it, Jason. This is something that has absolutely driven me to distraction over the last couple of weeks. Everything I read about MF Global makes my blood absolutely boil. Seg accounts are sacred. That money is my money. You, as my broker, should not touch it. And the fact that we find out over the last couple of days what MF Global was likely doing was doing repo arrangements in order to leverage up the customer's cash capital into what turns out to be risky Italian bonds is just unbelievable, and that the regulations have allowed that to take place, and that the holders of that cash are second in line in order to recoup that money is just beyond belief, absolutely beyond belief. Max Kaiser had a piece today where he talked about it, and when he was talking with Barry Ritolds say, why would you open a brokerage account if you didn't have kind of first dibs on your money, that someone else could come in and priority over your assets? Exactly right. This is nuts. This is absolutely a disgrace. Now, I'm sure this situation will play out in due course. I must admit I thought SIPC would be in here like a shot, and the money would be back in everybody's accounts within a couple of days, and this would be just a storm in a teacup and it would kind of go away. But it is not, and the story's gotten worse and worse and worse. Again, if you're kind of a listener to the blog, you'll know that I've got my money with Interactive Brokers, and they're pretty good in terms of communicating with their customers, regular kind of financial numbers, just saying that they are safe pair of hands, and I do trust them. But I'm sure a lot of people thought that of MF Global. There's something that I'm toying with at the moment, and I think I might act on in the next few days or weeks, and it's this. Now, if you've read any of the pages on Emini-Watch about kind of money management, normally what I recommend is having plenty of capital against each of the Emini contracts that you trade. And typically what I recommend is about $8,000 per Emini contract. Now, that was in a situation where the capital was entirely safe, and with MF Global we now have a situation where we know that the cash capital in your account might not be safe. The typical margin requirements, and I'll just pull this up from Interactive Brokers. Here's the Emini ES, and they tell you what the intraday and the overnight kind of holding margin required to open a position and to maintain a position. And this has gone up over the years, but now it sits at $5,000 if you're trading E-minis, holding them overnight and opening a position, so $5,000 per contract of capital required. And that's why I recommended having $8,000, so you just had plenty of room. You didn't want to kind of get close to any kind of margin calls or anything like that. And then once your position was open, the actual margin that they're calculating is $4,000, but you needed $5,000 to hold a position overnight as initial margin. Now these days I'm doing 100% day trading, so I'm not doing any swing trading anymore, just because the volatility in the market's kind of gone up that much, and I prefer to be out of the market at night these days. And for day trading, the initial margin required is only $2,500, and then the maintenance margin is $2,000. Now, you don't want to kind of play close to that. You don't want to be right at $2,500, but rather than using what I've been kind of recommending in the past, about $8,000, why not bring that down to $5,000 or $4,000 per E-mini contract? And I'm sure there's loads of kind of traders out there that say I'm absolutely nuts even using that much. They're probably using brokers that allow them to trade with $1,000 or $1,500 or something like that against their E-mini trades, and they're saying that's all I need ever. So maybe I'm just being a little bit kind of naive in terms of the margin required. But what I am thinking about doing is reducing the capital in my account, pulling it out, and just using enough capital for about $5,000 or $4,000 per contract traded, and then moving the rest of that kind of spare cash effectively out of the account and keeping it somewhere else. Now, I haven't acted on that yet, but it's been playing on my mind for a couple of weeks since we heard kind of the MF Global kind of story, and I'm just wondering if I'd love to hear some good news out of this MF Global story. The fact that they've not kind of come out with any kind of news releases of any note has let kind of the rumors kind of run wild on this thing, and I hope it's not as bad as the rumors kind of make it sound, because if that is the case, we've got a real problem in terms of the regulators and systemic kind of issues in kind of futures trading in general. So having said that, what I will be thinking about doing over the next few days and week or so is actually changing to a lot less margin per contract traded, and then getting that money out of that account just in case the worst case scenario happens. And I think, again, it's just one of these kind of prudent things. Once we have kind of new information that says, that your capital is not absolutely without risk, that you're holding it there, that Civic won't just kind of come in and say, all's good, don't worry, here's all your trading capital kind of back. That we don't have that kind of situation right now just means this has to be kind of considered as an option. So there we go, 2 questions to do with kind of systemic risk and some suggestions for how to deal with it.